Good afternoon, everyone, and welcome back to this edition of TBD Micro, your Colorado Springs real estate podcast. I'm Rob Thompson, associate broker here with the agency in Colorado Springs, and I'm joined again by my buddy Troy.
Hey there, how you doing today?
Good, man. How you doing?
Doing really well. It's a beautiful day out there, man. I'm loving it.
Right on. I've been inside for a couple of hours. So is it nice out there?
Yeah, you need to stick your head out the window occasionally.
Yes, you do. I agree. So we're back today, and we're going to talk about mortgage insurance. But before we get there, a couple of market stats. As we sit here, there are, according to the Pikes Peak Association Realtors MLS, effective 31 July, 2:01 p.m., there are 2,575 homes for sale in the MLS. Average sale price of these homes is $501,341. That's the average for sale price. The average for sale median is $388,900. In the last 30 days, or I take it back, it's 2,343 of those 2,575 are single family homes with an average for sale price of $515,357 and an average median sale price of $390. In the last 30 days, there have been 1,494 homes total sold for an average sale price of $336,517 and a median of $299, median of 7 days on the market, average of 24 days on the market. So we have just about 6 weeks of inventory, it looks like.
Well, that looks like to be about what it was the last time we met up, so it's about stable right now.
Yeah, slightly more inventory. There's I think the last time was 5 weeks or so.
That's right.
Which is incremental, but anyway, that's our market stat. Still a seller's market in a lot of ways, although I will say anecdotally, I have seen it slow down. Anecdotally, the buyer contact volume is lower, and then I have a couple listings that I haven't changed my strategy at all, but they are sitting on the market a little longer. Still interest, but anyway. Then again, over the weekend, I wrote an offer on a property that ended up with 7 offers. So still a booming market in a lot of ways.
Yeah, and what I've noticed from a lending standpoint with talking to agents about how to potentially structure the offer from a mortgage standpoint is people are a little bit more apt potentially to help out with, seller help on those kind of things, which tells me that, there is more inventory out there. So I'm seeing that on the mortgage side as well.
That's good affirmation. So we're here today to talk about mortgage insurance. What the heck is mortgage insurance, and why do I need it? Do I need it? What is it? Can I opt out?
All that fun stuff. So it's exciting, for me anyway, maybe not for you guys out there, but mortgage insurance is definitely an important part of how you figure out what you're going to be making payments on is from a monthly payment standpoint. So what is mortgage insurance? In layman's terms, mortgage insurance is for the lender. It is not for you. It does not insure you, and it protects against mortgage default. So if someone were to start going under foreclosure and can't afford the payments anymore, this insurance covers the mortgage company to make sure they're made whole on that and they don't lose any money on that. So that's ultimately what it is. What is mortgage insurance based upon? It's based upon the type of loan you get, and it's also based upon the amount of down payment that you put on a particular home. So we're going to break that down a little bit here. Conventional loans, FHA loans, VA, USDA. We're going to talk a little bit about each of those. Do they have it? And if so, what does it look like as far as mortgage insurance? So on a conventional loan, if you put 20% down on your primary residence, you do not need mortgage insurance. What that means is you're putting 20% into the home, and from a conventional loan standpoint, they say, well, there's really no risk anymore, or there's not enough risk to have to pay mortgage insurance, because if they do default, the bank should be able to sell that home at least, break even, but probably make a little bit of a profit on that. So they have no reason to put mortgage insurance on that home at that point. So 20% down, you're clear on the mortgage insurance. If you're unable to put 20% down, you will have to get monthly mortgage insurance, and it's incremental. So every 5% you put down, then it's less mortgage insurance on your monthly payment. It's pretty simple math. And again, the more you put down, the less percentage you have to pay. So there is something called lender-paid mortgage insurance too. So if you put less than 20% down, but you do not want to have the monthly mortgage insurance as part of your mortgage payment, the lender will pay for that for you, in certain instances. However, it's an increase to the interest rate. So it's not free. Nothing is free. So your interest rate usually goes up, depending upon credit score and those kind of things. It can go anywhere from 0.25% all the way up to 0.75%. But it might make sense to be able to get the home to do that. So you can do that. There is a special conventional program called Home Ready or Home Possible that actually, with only 3% down, has some really, really advantageous mortgage insurance rates. It's for those that are, potentially first-time home buyers, those kind of things. And they did some math and some studies and figured that the risk was okay with even 3% down to get a pretty reasonable mortgage insurance for the amount you're putting down, which is pretty neat. So that's the conventional loan. You can structure it a bunch of different ways. Again, when you talk to a professional in the lending industry, they should be able to break that down for you and say which one they might recommend.
Okay.
Yep. So then, I'm sorry, Rob, go ahead.
It's kind of interesting that we have to pay the premium to insure another party on the whole idea of mortgage insurance.
Yeah, I mean, it is an interesting concept, but I would say this: it makes sense in my world only because the insurance is for the lender, but it's because the individual could not put enough down to reduce the risk. So,
and with that, you just changed my frame of mind about that whole idea. Good point. Yeah. Yeah, it just went click. I don't know if you heard the audible click, but okay, that makes sense.
And then, so there's FHA mortgage insurance. There's an upfront amount that you pay right when you close on the home, and it's financed into the loan, so you'll have a higher monthly payment and those kind of things. And then there's a monthly mortgage insurance. The FHA keeps an eye on those, and they change those periodically. It's not an annual thing. They change it when they see the market determines the need for that. So right now, upfront mortgage insurance is 1.75% of the loan amount. So, on a $200,000 home, if you have to put 3.5% down on an FHA loan, that's $7,000 down, or $193,000 would be your base loan amount. Then you get to add 1.75% onto that. So they do an upfront and a monthly mortgage insurance, which is currently 0.85%.
And or?
And
okay.
Both are applied. So you're getting double hit on the mortgage insurance.
Okay.
But, if it allows you to get into a home, remember FHA loans are there for folks who might not have the best credit scores, or there's something that's slowing them down, maybe a bankruptcy that hasn't been old enough yet for conventional loan, but it's been old enough for an FHA loan. So
it's a good point too. I mean, you got to weigh the cost associated with that. Every month that you rent, you are not building equity potentially. And then when you're looking at that, like, okay, if I wait till I have the down payment, how much rent will I have paid while I'm waiting to build the down payment?
That's absolutely correct. And what does the market bear as far as potential interest rate down the road? So there's
another variable.
Yeah, you got to look at all of that. We try to put the crystal ball out there and try to show folks what we kind of see. No promises, of course, but we try to put those options in front of people to see if it's a good idea to purchase now versus maybe fixing some things and getting into a conventional loan pretty quickly. Maybe that's we try to do that. So the other thing is, when you're purchasing a home, the FHA mortgage insurance never goes away unless you refinance, or you sell the house and you buy another home on a conventional loan. So that mortgage insurance is on for the life of the loan.
It used to be 80%, right?
Well, on an FHA loan, they changed their guidelines back in June of 2013. It did fall off after 11 years, but on an FHA loan now, on a purchase, I want to be clear on that, on a purchase, it stays on for the life of the loan unless you do some type of refinance. So,
gotcha.
Yep. And so it's a infinite cost for 30 years unless you move out of the house or get your credit score up, and it makes sense to refinance into a conventional loan later on down the road. So that's kind of the FHA. Again, FHA is not a bad loan. It's just for people who need that type of loan to be able to, if it makes sense, to get into a home. Now, VA, on the other hand, there is no monthly mortgage insurance. That's one of the amazing benefits of a VA loan, with no down payment. Again, if it makes sense from a budgetary standpoint. So, no down payment, no monthly mortgage insurance. There is what's called a VA funding fee. It's kind of like the upfront mortgage insurance on the VA side. However, it's for a very different reason. There you can pay upwards of 3.3% of the loan amount in the VA funding fee, but it's not a mortgage insurance. It is a amount of money that goes to the VA that covers the VA in case they do have to pay their guarantee to a lender if a veteran defaults. So same kind of structure, but it's a little bit different there. So there is a potential cost, but again, no monthly mortgage insurance, which is really nice. Now USDA, you don't see too many of those in the Colorado Springs metro, of course, but USDA is it's income-based and it's location-based. What I mean by that is the particular address that you're trying to purchase has to be approved by the USDA. Usually it's your rural areas, eastern Peyton, Ellicott, those kind of places. And so they have an upfront of 1% and a monthly of 0.35%. So there is a lesser amount than FHA, but there are some income restrictions and there are some location restrictions that you have to go through. And again, it's a cost, so you got to take a look and see if it makes sense. You had asked, Rob, how do I get rid of monthly mortgage insurance? So let's talk about that for a second. So if you're in an FHA loan, you would have to refinance into a conventional loan if you wanted to get rid of that. You have to have a value of the home that's 80%, again, when you refinance. So let's say you've been in the house a while, you've been paying down on that loan while the values of homes are going up. That's absolutely what's going on right now. And if you look and talk to Rob and he says, I think your home is worth X amount of dollars, and you look at your mortgage statement and it says that you owe Y amount of dollars, and if it's 80%, then you might want to consider refinancing into a conventional loan and getting rid of that mortgage insurance, which should, as long as interest rate makes sense, lower your monthly payment and get you into a better budgetary stance. So you can do that. If you're in a conventional loan and you didn't put 20% down when you first started, you don't have to refinance. This is something people might not know. You can accomplish an appraisal and turn that appraisal into your current lender, and they would look at it and say, okay, a professional has said that the value is this, and they owe that, and they would just drop the monthly mortgage insurance without having to pay closing costs associated with a refinance.
That's good to know.
So you can do that. Now, sometimes people want to refinance because they want to get some of the equity out of their home, and maybe they can do that. But if you're not looking to do that and the numbers make sense, you don't have to refinance if you're in a conventional loan to get rid of that mortgage insurance. Now, if you're in a conventional FHA or USDA loan and have VA eligibility, let's talk about that for a second. I've been perplexed as to why some people get into FHA and USDA loans if they have VA eligibility. Now, sometimes it makes sense. I'm not saying that it doesn't make sense, but there are other times when I talk to individuals and they said, well, somebody told me that VA loans are bad, and the absolute answer is no loan is bad. Every loan is out there for a reason, and VA loans are great loans if they make sense. So if you have VA eligibility and you want to get rid of the mortgage insurance, you can refinance into a VA loan, which doesn't have monthly mortgage insurance, and potentially lower your budgetary stance that way and lower your monthly payment. So there's a lot of different ways to do it. I pride myself in trying to put people on the best road that makes sense to do that, and would be happy to help out in any way I could to see if that makes sense for anybody out there.
Oh, thanks, man. That's probably the most comprehensive rundown of mortgage insurance I've heard yet, and actually that did help recast the idea in my mind. And as you were talking about the different types too, I was even thinking how as a VA eligible borrower, I bought a home on a VA loan, and I had no problem paying the funding fee. But when I think about FHA loans, I'm like, I got away with, not got away with, but I didn't have to pay but in reality, the VA funding fee I did.
You did, yes.
just different, slightly different definition, but. Anyway.
That's right. And so, going over all that information, there are times when a conventional loan makes more sense for a veteran, potentially.
Potentially, if you have the down payment, and That does make sense.
Well, if you have any questions out there in the podcast world, you can reach the Reichert Mortgage team at www.reichertmortgage.com, or again, call me directly on my cell phone, 719-205-0413. Love to help out.
Right on. And so we usually end with a recommendation. You read any books or listened to any podcasts recently you'd recommend?
Well, I would like to recommend, again, this is me personally, kind of a polarizing character in my mind. I've heard pros and cons, but I am a big proponent of Dave Ramsey. I'll be very honest. When I bought my house, I thought it was smart to put all my landscaping and new furnishings and blinds and everything on a credit card, and racked up $35,000 worth of debt on my credit card, which was completely didn't need to do it,
Right.
And so I went through Financial Peace University, and just kind of gave me a new outlook on the cost of money. And he, if you just go Dave Ramsey podcast, it's always out there. He's got his own radio show. I think he really kind of simplifies things. And now I will say this: you definitely need established credit. He has a different tack on that. You need established credit usually to get the best interest rate. So if you want a credit card out there, definitely get one, but pay it off each month. That way you have that established credit. But other than that, I think Dave Ramsey's got some really good insights into how to treat money.
Right on. I'd put out there that I just finished the book Anti-Fragile, and I will just say this: it's eye-opening in a lot of ways. It's about systems and fragility of systems, and including debt, and it talks a lot about, or the takeaway for me is it talks a lot about the artificial pressures that our current complex economy and system applies to us, to include debt, and so it's changed the way I look at, or it's helped articulate the way I look at a few things, and it's helped me. So Anti-Fragile,
Very cool. Yeah, I'm afraid to read that book. I think is probably because I will have my eyes open, so maybe I need to jump in.
Well, here's one example of so I like Dr. Pepper, and that's not a plug for Dr. Pepper. I don't make any money off that plug, but I like Dr. Pepper, and he said something about soda that now when I grab a Dr. Pepper, it's changed my whole outlook on drinking that. Not to say I still don't, but I've slowed down because he pointed out that nothing like that has existed for the majority of human existence. Nothing like that soda, and that soda is the pinnacle, if you will, of technological development. I never thought of soda as a pinnacle of technological development, but it's specifically engineered to maximize our taste buds, and at the cost of nutrition. There's no nutritional value there, right? But so thinking about it like that, as I'm drinking that Dr. Pepper, it has changed the whole way I experience that. I'm like, this thing is specifically engineered to maximize. 50, 60, 70 years ago, sugar and things like that we didn't have this daily digest of in a Snickers bar. The same thing. He specifically uses Snickers, I think, as their candy bar as an example. That thing is engineered to maximize the taste experience. That's it. And so when you think about it like that, and think about that, for the vast majority of human existence, nothing like that existed. Are our bodies wired to actually process that food or that Dr. Pepper no, they're not, and so it's kind of an interesting thing. He says that he only drinks water, wine, and beer water, wine, or coffee, because those things are at least 1,000 years old. So our bodies have had time to evolve to those. Just a different way to look at things.
Yeah, I graduated culinary school, and so I think about foods a lot, and in its rarest form is what people were doing, and so if you think about it from the dawn of man, why do we like sugars? Why do we like starches? Why do we like those things? Because those are the things that are supposedly fueling us in the right form, and being able to work and being able to do those kind of things. So when Dr. Pepper or Snickers or whatever, they are going to the nth degree with no nutritional value. So that's very interesting. So
yeah, it's really changed the way I look at that, and I haven't had a soda in a couple of days now. So
I'm a nice tea guy. So
they're right on. All right, man. Well, thank you for your time. That's been talking about mortgage insurance. And again, how do they get a hold of you?
You can give me a call directly, 719-205-0413, or check me out at www.reichertmortgage.com.
Sounds good. Thanks for your time, man.
Thanks, Rob.